Hi, everyone. Really excited to be going into 2025, and part of that is being prepared for what's coming and also just making sure that we feel ready to end 2024 with a bang. So, today I'm just going to walk through some year end updates to set yourself up for a successful 2025 and review a couple things that you'll want to think about over the next couple weeks as we end out the year to make sure that you're prepared for what's coming. So, with that said, uh, we're going to get right into it. And yeah, so some things that you'll want to know for 2025. There's a couple things that topically we're going to cover. What's new for 2025 is going to include a little bit about taxes, what's changing, what's staying the same, retirement account changes as well, just limit changes and some other things that you'll want to think about when it comes to your retirement accounts. The Secure 2.0 Act and changes that are coming in 2025, we'll talk a little bit more about that and Social Security and Medicare changes. We're just going to briefly cover these topics, but if any of these topics resonate with you and you want to talk a little bit more about any of those, Coach at Questus is a really good tool for diving a little deeper into any of the particular things that are concerning for you or that you just want to learn more about. I will also cover moves to make before 2025. Like I mentioned, there's some ways to prepare yourself and to be putting your best financial foot forward in the new year. Okay, so let's cover tax changes real quickly. So, notable changes for the tax year 2025. These are just your basic changes we see every year. Standard deduction changes. A single or filing separately filer is going to have a standard deduction of $15,000, slightly up from 2024, increase of $400. Married or filing jointly is $30,000, which is up $800 from 2024. And for heads of households, the standard deduction will be $22,500 for tax year 2025, an increase of $600 from the amount for tax year 2024. So pretty small adjustments, but not too bad. Nice even round numbers there. So those are some of the standard deduction changes we're looking at. Marginal tax brackets, we're going to cover a slide on this, so more to come on that. But marginal tax brackets are changing. Earned income tax credit. So this is one that is a little more complicated because your eligibility is based on a table that the IRS has put together. So I'm just going to say here that the maximum earned income tax credit is $8,046 for 2025. And there is I think I do have a link. I don't have the link for this. So what I would recommend is looking up IRS EITC table, and it'll populate directly to the IRS site. There'll be a lot of other websites too that may explain it a little better, but the IRS site is where they're basing that info on. So if you have questions on that, you can ask your CPA or a tax preparer. You can go into your tax preparing software if that's what you use and kind of calculate, play around, see what's going on for that, or you can look that up online. The qualified transportation fringe benefit, this is something that not a lot of people qualify for, but I brought it up because it is a benefit that some employers provide. So the monthly limitation for qualified benefit for transportation and parking is going to be $325. So that's a write-off that you may be eligible for, and that has changed slightly in 2025. Just to remind everyone too that these are for 2025 when you file in 2026. So when you file in 2025 for 2024, last year's numbers are going to be the right ones. So 2024 numbers. And we do actually have a workshop we did on these numbers last year, this time last year. And so if you are curious about what those numbers are, you can search them, but also we do have a webinar we did, and you can find that in the platform. You can just search for probably tax or 2024, and it'll populate somewhere in there. Or it might be on our YouTube channel, so check that out. Okay, next is some other changes that relate to IRS limits. So a few more important changes include that the FSA and max carryover limits are changing. So let's briefly talk about what this all means. So an FSA, just as a reminder, it's a flexible spending account. You might have seen it when you were signing up for your benefits this year, and it is tied to an employer-sponsored savings account, and it lets employees set aside pre-tax funds for qualified medical expenses. It can be tied to any kind of health plan. It's often seen with a traditional health plan, and so if you're not sure what this is or if you qualify for it and you're in open enrollment, please reach out to your benefits team or take a look at what your benefits are. But usually with an FSA, it's for medical, but it can also be for child care too. So that's kind of a cool feature of an FSA. So the max contribution to a flexible savings account from your withholding is going to be $3,300, and that is your annual max pre-tax deduction. So when we say pre-tax deduction, that'll mean that money is coming out of your paycheck directly before it's been taxed, so it effectively decreases your income in the year that you deduct that money. So the max is going to be $3,300 in 2025, which is an increase of 275, or I'm sorry, it equals 275 per month. Keep in mind here that an FSA money is use it or lose it. It's different than an HSA. So an FSA, the money that you put in there, you want to be sure that you're going to use most, if not all of it, because there's only a carryover amount that you can bring into the next year of $660 next year. So if you feel like you are going to be able to take advantage of that high dollar amount in that tax year of 2025 and maybe only leave about $660 to roll over to the next year, then that is the max. And that's all very strategic as well. So your medical bills and what they look like, but you also don't know if those could change. So something to keep in mind. One other thing I'll mention about FSAs is that there are qualified health expenses that you can use that money for that are pretty liberal. So when you're considering how much money you want to put there, check what the FSA things that you can buy with your FSA with your employer. It'll normally be in the health insurance listing. Then with HSAs, this is a health savings account. This is also a tax you get your deductions pre-tax into your HSA. The difference with a health savings account from an FSA is that the health savings account is yours and it's linked to you. And so therefore that money can go with you. If you leave your employer, it doesn't go away. It's not use it or lose it. And so you are able to contribute pre-tax into a tax advantaged account that continues to grow tax-free, can be invested, and can actually build a balance over the years tax advantaged. If you use the money for health costs that are qualified, it is also tax-free to take the money out. So HSAs are often called triple tax advantaged. So the max contribution limits here, self only, are going to be $4,300. That's annually. Self plus family is $8,550. Pretty high. And the catch-up contribution, if you're over 55 plus, is $1,000. So something to think about, considering that you don't have to use it or lose it for an HSA. The annual exclusion for gifts, I'm bringing this up because it is the time of year to gift. So 19,000 per donee, that is 19,000 per person you want to gift to without using your lifetime gift or estate tax exemption. And so that means that if you wanted to donate or you wanted to gift up to 19,000 for like 5 of your grandchildren and you're feeling very generous, you would be able to do that. without it going into your estate tax exemption. And if that doesn't make sense to you, that's okay. But if you do have any further questions on that, the IRS has a pretty clear explanation on that. And if you're trying to figure out how to fit that into your spending plan or your goals for the future, coaches can help with that. All right. Let's talk briefly about marginal tax brackets. And this is just we're going to breeze through this, but I put this on here to allow you to take a screenshot if that's helpful. But these are the tax brackets for 2025. And keeping in mind with tax brackets that within the amounts that are showing the range. So if we look at tax rate 10%, if you're single, 0 to 11,925 of that is at the 10% rate. Anything above that is at the 12% rate, etc. But it's not your full salary that's at that 12 anymore. It's just anything above the 11,925. So that's how the marginal tax brackets work. If you have questions about that, I know there's always a little confusion on that, especially if you're a younger person kind of figuring out filing taxes. So you can always go to the IRS website. This one is sourced from the IRS as well. So very clear, but if you have questions about any financial topics, coaches can also help with that. So let's talk briefly about retirement accounts and workplace plan limit changes. And this is just so you know what's coming for preparing yourself for the next calendar year. So we'll talk briefly about workplace plans. So all workplace plans have a max employee contribution limit in 2025 of $23,500. This has gone up $500. So next year you have 500 more you can put into a workplace plan. This can be in Roth or traditional or both, depending on what your employer offers. So ask about what they offer if you have questions about that. If you are over 50, then you can do a 7,500 catch-up contribution. So that is something that you may want to take advantage of if you are 50 and over, you're starting to think more seriously about getting money into your retirement accounts. That's a huge benefit that exists. That has not gone up from last year. That's the same catch-up contribution. However, and this is part of Secure 2.0 Act, which we will talk about, but I want to mention it here because it's applicable to your workplace plan. If you're 60 to 63 in 2025 and your workplace plan allows it, the IRS has allowed catch-up contributions of up to $11,250 in 2025. So if that's you, consider if that's something you want to do, if you can do it, if you want to try to make it work, we can try to fit it into your spending plan, but check with your employer to see if they're allowing that. It is for the calendar year in which you turn those ages. SEP and simple IRA plans work differently. So if you have one of those, your spouse has one of those, ask a coach or check out the IRS site for updated maxes on those. Alrighty, so now we're going to talk about individual retirement accounts. These are IRAs. They are also retirement accounts, but they're not connected to an employer. They are accounts that you can open yourself. So an IRA traditional, that's going to be pre-tax income, meaning you have not yet been taxed on that money. That's going to be $7,000. IRA Roths are the same. That's money that's already been taxed. That limit is $7,000. This year, going into 25, it has not increased. So it is the same contribution limit as 2024. There is an additional $1,000 catch-up contribution if you're over 50. And there are income limits to contributing to a Roth. So you want to keep that in mind if you're considering contributing to a Roth IRA. Keep in mind that these income limits do not apply to a Roth workplace plan. So Roth 401k, 403b, 457, those you can contribute to that Roth no matter what your income. But if you're opening an individual retirement account or you have one and you want to contribute, there are max income limits. It's adjusted gross income that they're looking at. So if you're not sure about that, go to the IRS website and do a little bit of research on if that applies to you, because I've put the max limits here, but there's phase out windows in which you can contribute some of the max, but not all of it, depending on your income. So go ahead and look into that. Coaches can provide basic information about this info, but we can't provide tax advice. So if you have a tax specific question, I do recommend you reaching out to a tax professional or your tax preparer. Keep in mind too, if you're married filing separately, you can each only earn $10,000 to qualify to contribute. So if you're married filing separately, Roths are almost impossible to be able to contribute to because they have such a low income threshold. So married filing jointly and single are both ways in which you can contribute to a Roth. Okay. And a note about the traditional IRA limit. So I mentioned that traditional IRAs have a max, they are pre-tax money, but you're probably thinking, well, that makes sense for a workplace plan because they're taking it out of my paycheck. But how would I put pre-tax money into a traditional IRA? I've already been taxed on it. And you are correct. So if you choose to put funds in a traditional IRA, it would be via already taxed income. Why would someone do this? Well, if you make too much to contribute to a Roth IRA, then you might put money into a traditional IRA and then either convert it later or take a write-off and deduct it from your taxes when you file, depending on the IRS limits. And that's why I'm bringing this up, because if you want to deduct a traditional IRA contribution, there are rules around that, and you want to make sure you're aware of that. So if you want to do a traditional IRA contribution with money that's already been taxed and you want to deduct it on your taxes, then and you're covered by a workplace plan, then your phase out salary to be able to do that is $79,000 to $89,000. If you're married filing jointly and the spouse is making an IRA contribution and is covered by a workplace plan, the phase out is $126,000 to $146,000. And if a spouse making IRA contribution is not covered by a plan, then the phase out is $236,000 to $246,000. Married filing singly, same thing. They have a phase out range of 0 to 10,000 in income. So it's very low. And if you choose not to deduct the contribution or you earn too much to do that, then you can track how much you've contributed and report it to the IRS. So you're tracking how much has already been taxed. And that might be important when you decide to do a conversion to a Roth. This all gets very complicated, but I just wanted you to know those limits because I want people to be aware that these limits exist and there are rules around traditional IRA contributions after tax. Okay. If you're not sure what's right for you, you can talk to an expert, you can talk to a coach. Again, we can't give tax advice, but we do help people find ways to fit whatever is their strategy into their spending plan. And we also figure out ways to achieve those goals for people. So if you have questions on how that works for you, reach out. All right, lastly is Secure 2.0. And this is just a little bit of updates for 2025. This act actually passed a couple years ago, back in December of 22. There's been a lot of changes that you may or may not be aware of, but a lot of what Secure 2.0 Act did was specifically for retirement accounts. So the three major changes you'll want to know about in 25, one of them I already mentioned. So it's called the Super Catch-Up. It's a higher catch-up contribution for people aged 60 to 63, and it's an additional $11,250 going into a workplace plan instead of $7,500 for 50 plus. So that's a huge change. And again, ask your employer if that's going to be possible for you if you fall into that age range in 2025. Retirement plan coverage for long-term part-time employees is now being mandated, and there's rules around what qualifies you as a long-term part-time employee. So if you are not sure about that, ask your employer. I also do have some information I'm happy to share if this is something that applies to you. Required automatic enrollment for newly established 401k and 403b plans. This is something that employers are required to do. And this is going to be any employer who established their plan after December 28th, 2022, they have to automatically enroll you in your workplace plan, and they can default contribute between 3% to 10% of your pre-tax salary. So you have to opt out if that's not something you want to do. So if that's you and your employer had opened their employer plan after December 28th, 22, then you want to make sure you're logging in to see what's going on. Are they automatically deducting or not? If you have questions about that, you should ask your employer. And there's also going to be a mandatory searchable database for lost 401k plans. So this is going to be activating supposedly by the end of the year. So sometime next year, if you feel like you have a retirement plan out there at some point that you just forgot about, you didn't roll it over, you want to know if it's still there will be a way to search those. And so that is going to be a huge feature of Secure 2.0 Act that really empowers us as employees and also employers to be able to say, hey, our employees earned this and we don't want it sitting here doing nothing. We want it to go where it belongs. Okay, briefly on Social Security and Medicare, just some changes here. The wage base will increase to 176,100. This means up to this amount that you earn will be taxed for Social Security purposes. Anything above that will not. And for wages over 200,000, there will be an additional increase for Medicare parts A and B costs that will be a tax of 2.35% for wages over the 200,000 threshold. There will also be an increase in cost of living if you are accepting Social Security, and that's going to be 2.5%. Keep in mind though, Medicare parts A and B are increasing in cost, so that might weigh, to kind of balance out. So steps to take to bring to be financially savvy in 2025. So one thing I always recommend people do, I do it, and I definitely recommend people do, is estimate your withholding. Did you withhold enough? This is something that you can do now. Now, there's not a lot of time to do a whole lot here, but it does help you to make changes if needed to your W-4 in the new year or to your estimated tax withholding, whatever it is that you're doing to pay your taxes. I like the IRS withholding tax calculator. I just Google or search withholding tax estimator IRS and it brings it right up. And I like this because it's the IRS, so it's going straight from the source of where I'm going to be taxed. So I feel fairly confident that it's giving me good numbers with the data I'm putting in. So give that a try. Also keep in mind that estimated taxes are due January 15th of 25 for this quarter. So you may still have time to be able to make tax payments if you've underpaid for the 2024 tax year. Consider tax loss harvesting and carryovers to offset capital gains. I'm not going to get into this very much, but I want you to know the jargon there. Tax loss harvesting is basically a way of when you have a lot of gains in a taxable brokerage account, let's say investments that are going to be taxed. Tax loss harvesting would be selling some investments to sort of at a loss to sort of balance out your tax kind of bill at the end, because yes, you had gains, but yes, you had losses. There's more to it than that, but just keep that in mind as you're kind of doing some research on if that works for you. And if you've been on the fence, contribute to those tax advantaged accounts. You still have time. So think about that. Consider itemization, itemizing. That's something we talked about already as far as the itemized deduction. Maybe if you're spending a lot out of pocket for medical, for donations, maybe you want to itemize. So consider what's going to be best for you. Consider deferring income to January 25 if you have the ability to do so. And get organized. Know where your money is and where your important documents are. This is something we should do regularly, but of course it always falls to the wayside because we don't have time. But this is a really good time to reset. You might have some time off. You might be trying to get a little break from the chaos of the holidays. And so maybe put yourself in like a calm kind of space, put some music on, have some tea, and get organized with your money, get organized with your documents. It's the best gift you can give to your loved ones. All right. I think that's everything. I just want to mention that if you'd like to schedule a 30-minute session with a coach, they're unlimited. It's always a good time to do it, even if you're not even sure what you want to talk about. We can help you get organized about your goals. And then, yeah, I think that's everything. So if you have any questions, please reach out to me. It's kimberly.essie@questus.co. And you can also find me at questus.co/coaches. You can log into the platform go.myquestus.co and log in there and talk to a coach that way as well. We're available on chat. Usually we'll respond within 24 hours or so. So please reach out to us. Well, with that said, I hope you have a fantastic 2024 and a 2025 ahead.